Welcome to The Explainer. So, we've got our hands on the newly released April 2026 data from the Federation of the Swiss Watch Industry, and let me tell you, it's a wild ride. If you follow global luxury markets, you already know Swiss watch exports are a massive economic indicator. But this month's headline number, well, it definitely raised a few eyebrows. So, let's peel back the layers and see what's actually going on here.
Okay, let's dive into this. Negative 16.6%. Yeah, you heard that right. Total Swiss watch exports dropped by that massive amount in April 2026 compared to the exact same time last year. Now, in the high-stakes world of high-end luxury, a double-digit drop in a single month immediately begs the question, right? Has the luxury bubble finally burst? To figure out exactly how a historically rock-solid industry posted a decline this steep, we first really need to zoom out and look at the trend. When we track the 12-month moving average of these exports, you see your standard, everyday fluctuations throughout 2025 and early 2026, mostly just hovering right around zero. But then, bam, April 2026 hits and it is an absolute cliff dive. In absolute terms, total exports plunged to 2.1 billion francs. We are talking about the sharpest decline seen in recent tracking, completely dragging the first 4 months of the year down to a cumulative 3.9% fall. The trend was practically coasting, and then suddenly, the bottom just fell right out. So when you see a sudden drop-off like that, you really have to ask yourself, what exactly stopped selling? Was it absolutely everything? A cumulative 3.9% fall for the year so far tells us this isn't just a tiny, easily ignored blip. To really wrap our heads around it, we've got to break the market down. We need to dissect the different tiers of luxury. Because let's be real, a billionaire dropping cash on a diamond-encrusted timepiece behaves very, very differently than a young professional saving up for their first nice steel watch. And this brilliantly illustrates exactly where the pain points are. When we break wristwatches down by export price categories, the drop is stark. The absolute highest tier models, those priced over 3,000 Swiss francs, took a massive hit. We're talking a steep 19% decline in value. Actually, the pain is kind of spread across the board. Entry-level watches under 200 francs fell 14.3%, and the 500 to 3,000 franc range dropped 12.2%. So it hit almost every single tier. But those ultra-luxury, high-margin pieces, they definitely took the hardest hit by far.
But amidst all this red ink, there is actually one fascinating exception. It's the lone bright spot. The category of watches priced between 200 and 500 Swiss francs. While the ultra-luxury models were basically taking a nosedive, this mid-tier, much more accessible luxury category actually grew. It went up by 7.7% in value and 4.7% in units. It's like people haven't completely stopped buying Swiss watches, right? While the ultra-wealthy buyers might be tightening their belts, the everyday premium segment remains surprisingly, resilient.
Now the story shifts a bit when we categorize these watches by the materials they're made of. Since the ultra-high-end watches dropped, it makes total sense that precious metal exports absolutely plummeted, falling a whopping 24.3% in value compared to last year. But here's the kicker. The real blow to the overall volume actually came from steel watches. They dropped over 10% in units. That drop in steel is what drove the bulk of the 129,000 fewer watches exported this April across all materials.
Okay, so we know what isn't selling, the high-end precious metal pieces and massive volumes of everyday steel watches. But to really figure this mystery out, we have to change our lens. We need to shift our focus away from the what and onto the where. Was this a sudden, totally synchronized global rejection of luxury? Like, did consumers everywhere just wake up and simultaneously decide to stop buying Swiss watches in April 2026? Because if this is isolated, then we have a very different kind of whodunit on our hands. Well, the geographic data proves this isn't a synchronized global downturn at all. The global market is actually completely fractured. On one side, you have countries like Japan, the UK, Germany, and the UAE seeing really significant falls. But then, there are several major Asian markets that are actually surging. Singapore and China are both up over 17%, and Hong Kong is up 13.5%. These Asian markets are totally pulling their weight. So the world isn't united in a watch buying strike, it's completely split.
To really highlight how paradoxical this geographic split is, just compare the extreme outliers. On one hand, you have France, boasting a massive growth of 46.3%. Now, a quick caveat here, the source data explicitly warns us that this huge French surge doesn't actually reflect the real trend in their local retail market. It's highly likely just a logistical anomaly or a distribution hub effect. But then, on the exact opposite end of the spectrum, we have the United States, a massive staggering drop of 56.4%.
Literally over half of the export value to the US just vanished compared to last year. Poof.
So here is the inherent tension in the math. With major Asian markets surging and mid-tier watches actually growing, how on earth you get a global average dragged all the way down to negative 16.6%? Who exactly is the main culprit here? I mean, who has enough market gravity to pull the entire world down even when other massive economic zones are having a genuinely great month? Think about it. To sink a ship when half the compartments are completely full of air, you need one incredibly massive leak.
And that massive leak? It's the United States. But it's not what it looks like. It is due to what economists call an unfavorable base effect, which is basically just a really intense statistical hangover. The US market is so incredibly gigantic that it completely dictates the global tone. But listen, Americans didn't just suddenly decide they hated Swiss watches in April 2026. What actually happened was, last year, an impending US tariff increase was announced. That caused massive panic buying and a totally unnatural spike in exports just to beat the new tax. So when you compare this perfectly normal April to last year's wild panic buying spree, it creates the absolute illusion of a 56% crash.
So the crucial point is this figure, positive 8.9%. If we strip away all that noise, if we completely ignore that insane tariff panic from last year and look over the longer term, the picture completely flips. When we compare today's numbers with April 2024, which was a totally normal, non-tariff panicked year, the US market has actually grown by 8.9%. That right there is the real underlying trend. The primary engine of the global luxury watch market hasn't stalled out at all. It's humming along and growing healthily. That terrifying headline number, it's really just a ghost of last year's trade policy drama.
Which brings us to our final and maybe most important question. Is the sky really falling, or are we just reading the wrong coordinates? When we kicked off this explainer, that negative 16.6% headline made it look like the sky was absolutely falling on the luxury world. But as we've just seen, once you isolate the regions and truly understand the historical context of those US tariffs, the entire narrative completely transforms. It is such a powerful reminder that when it comes to data, context isn't just a little thing, it is absolutely everything. The sky isn't falling. We were literally just comparing today's completely normal weather to yesterday's Category 5 hurricane. It definitely makes you wonder, doesn't it? What other terrifying economic headlines are out there right now, just waiting for someone to look past the base effect? Thanks so much for joining me on this explainer.